2008, the year when millions have lost their life savings because of a bubble not many people saw coming. Back then, because of the easy access to trash loans, people who should not be able to buy one house were able to buy four, which had its effects on the economy. Fast forward 2023, housing prices are sky high, as well as interest rates, so people are worried that it's all going to happen again. So here's the question: does history repeat itself, or things are different now? You probably heard the news that the average 30-year mortgage in the United States is over 7.6%, which makes it the highest level for the last 23 years. The situation appears dire when viewed from this angle. Everyone is questioning the stability of the market. But what is the threat here exactly? You see, mortgage loans are basically the backbone of the housing market. When someone wants to buy something expensive, like a home, they are very likely to turn to a bank to finance that purchase. But here is the problem. Believe it or not, in the last decade, the most important financial factor for people when buying a house was not the asking price, but the monthly payment it will require. It's all good when interest rates are low and you can lock in a 30-year fixed mortgage at around 3%. But right now, the average interest on a 30-year mortgage is more than double that, which means that the monthly payment is getting more expensive, so people cannot afford to buy a home so easily. And when people stop buying houses, demand falls and prices start falling, right? Technically, yes, but there's more we need to talk about. We have a bear and a bull argument to talk about, so in the end, you can make your own decision. If we take one step back into history and look at the housing market, we'll see that what is happening today is far from normal. A lot of people like to brag about what a good investment was it to buy a house because it doubled in value since the purchase, and they will show you a chart about average home prices, but keep in mind, charts like this, yes, they're showing you housing prices throughout history, but they have a severe flaw. It fails to capture the all-important aspect of inflation. And over a 20, 40, or 50-year period, the power of inflation is incredible. When someone mentions purchasing a house 2 decades ago for $200,000, it might not automatically signify a fantastic deal. Adjusting for inflation, $200,000 in the year 2000 would equate to around $356,000 in today's 2023 dollars. While it might seem like a nice gain, it is under the stock market average. But even with this information in mind, we can clearly see that buying a home today is expensive. To accurately show market trends, we need to account for inflation and showcase the true growth in home prices. The inflation-adjusted Case-Shiller Index offers a way to illustrate real home price changes. This chart provides an unfiltered view of how homes are currently overpriced, unaffected by the declining value of the dollar. You can see that we've exceeded the levels of the previous monumental housing bubble in US history. Thanks to the Case-Shiller Index, we have reliable housing price data dating back to 1889. The peak in 2008 was unprecedented, reaching levels once deemed unattainable. But despite a consistent upward trend in real prices over the last century, today's housing market surpasses 2008. The period post-2012 has departed significantly from what was considered normal. This departure from the norm raises concerns about a potential return to a similar scenario. History teaches us that the development of the 2008 bubble after the year 2000 wasn't entirely unexpected. And if we rely purely on technical analysis, we can make a case for a housing crash in 2024-25. And there's another point in this argument where even bullish perspectives may struggle to counter the likelihood of a crash. You see, interest rates on mortgages used to be quite high in the past. Over the last 30 years, they've gradually gone down, setting the stage for the 2008 housing bubble to form and burst. But that experience didn't teach us much. After the 2008 crash, the Fed kept rates super low, even hitting a low of 2.6% at one point. This led to a new housing bubble starting around 2011 that's still going strong today. The actual adjusted for inflation price of homes shot up by 66% outside of the 2008 surge. This kind of fast price increase has never really happened in US history without leading to a crash. It's a pattern we all seen before. The other bear factor you should pay attention to are interest rates. You see, the housing market is like a pendulum swinging back and forth in response to changes in interest rates. This is particularly significant because most people buying homes or investing in real estate rely on loans, often choosing the stability of the 30-year fixed mortgage. Now, without diving too deeply into the technicalities, this specific mortgage type relies heavily on the 10-year Treasury bond, which acts as a key factor in shaping mortgage rates. You might wonder, how does this whole financial dance impact the value of my home? To demystify this, let's paint a clear picture. Imagine a 10-year Treasury note as a special IOU issued by the government. It operates fairly simply. The government takes your cash today and in return promises to hand it back to you after a decade with a bit of extra money as interest. So when the 10-year Treasury rates fluctuate, it directly influences the interest rates for your 30-year fixed mortgage. These mortgage rates in turn affect how much people are willing to spend on homes. Essentially, when interest rates are low, mortgage payments become more affordable, enticing more buyers into the market. This increased demand often leads to higher home prices. Conversely, when interest rates rise, mortgage payments become more expensive, potentially dampening buyer enthusiasm and leading to declining home prices. In a nutshell, the fluctuations in the 10-year Treasury rates indirectly affect your home's value by influencing the affordability of mortgages, thus impacting the buying power and demand within the housing market. Okay, but why is this important? Currently, the 10-year Treasury rate stands at 4.2%, but here's where things get interesting. There's also a 2-year Treasury note sporting a higher interest rate at 4.5%. This scenario is quite unusual because typically longer-term borrowing means higher rates. When shorter-term rates surpass longer-term rates like this, we enter the realm of an inverted yield curve. In simple terms, it means that lending the government money for a short duration yields higher returns than lending for a longer period. Why does this matter? Well, inverted yield curves have historically served as a leading signal for an impending recession. Looking back at the chart spanning from the late 70s, every instance where the line dipped below zero, indicating an inversion, was swiftly followed by a recession. This trend held true in the late 80s, early 90s, early 2000s, and in 2008. In summary, an inverted yield curve stands out as a strong indicator, historically signaling a looming recession. When this pattern emerges, the likelihood of a recession approaching is very high based on historical data. It's essential to note that the real impact of an impending recession typically shows after the inversion cycle is fully complete. In the case of the 2008 recession, the significant economic downturn began years after the inversion. Presently, we find ourselves in an extremely concerning situation. The Fed is striving to elevate rates to their peak, yet the bond market seems to be challenging their efforts. Here's the crux of the matter concerning a potential future crash. Considering the 30-year yield, which is practically identical to the 10-year yield at present, this alignment indicates that investors are anticipating substantial inflation down the road. How do we know this? Well, it's basic economics. If the rate on a 30-year Treasury bond was attractive, rational investors would opt for it. Even high-profile hedge fund giants such as Stanley Druckenmiller or Bill Ackman are betting against the 30-year Treasury. Their actions signal a forthcoming shift in the financial scene, marking a significant sign of an imminent change. But what some people fail to mention is that the situation now, in a lot of ways, is the exact opposite of 2008. In 2008, the housing market saw an influx of unqualified buyers using subprime loans. These loans, often with adjustable rates promising lower initial payments that could skyrocket later, sparkled a surge in housing demand. This led to inflated prices and ultimately created a housing bubble. When these adjustable rates caused monthly payments to soar, many homeowners unable to afford them defaulted on their loans and transitioned to renting, a more affordable option. Fast forward to today, and there's a huge contrast from this scenario of 2008. Over the last 12 years, the predominant mortgage loans have been stable 30 years fixed mortgages with highly favorable interest rates. Consequently, homeowners aren't facing the risk of sudden increases in their monthly repayments. Another noteworthy aspect to consider is the significant number of prospective homebuyers currently waiting on the sidelines. When housing prices begin to dip, these individuals will likely view it as an opportune moment to make their move. Ultimately, these points are speculative, and it's premature to declare an imminent crash. If you're already purchased a house with a stable 30-year fixed mortgage and you can maintain a consistent income, congratulations. You likely won't need to worry about fluctuations in the housing market. However, if you're contemplating a new purchase, it might be prudent to use a bit of patience and wait for a little longer. Thank you for your time.